Hello students, now let us start with question number 37 of TS Kareval. You can see in this question that debt to equity ratio we have to find out. Debt means non-current liability and equity means shareholders fund, which is equal to share capital and reserves and surplus. And these items are not given in this question, rather indirect items are given. The first item given in this question is total assets, which is equal to 2,60,000. Total assets means sum of NCA plus NCI plus CA. Hence, I have mentioned here 2,60,000. Since this is a balance sheet, so total assets are always equal to total liabilities. So, the sum of shareholders fund plus non-current liability plus current liability will also come equal to 2,60,000. The second item given to us is total debt, which is 1,80,000. So, you can see that this red border. So, I have shown relationship of NCL and CL in total debt. When we sum up these two items, we get total debt. And here I have written the formula. NCL means debt. In order to find out debt, because current liabilities are also given, if we will remove current liabilities from total debt, what is left with us? That is debt is equal to NCL. And the same thing I have shown in first box. So your debt becomes 1,60,000. Now, total liabilities are given to us, which is sum of all three heads of liability side. If we will remove NCL and CL, which is total debt, from this total liabilities, what is left with us? That is shareholders fund. And the same thing I have shown in third box. So your equity becomes 80,000. Now you know debt, you know equity, you can easily find out debt equity ratio, which is 2:1. Now we are going to start with question number 40, in which we have to find out debt to equity ratio. Debt means non-current liability and equity means shareholders fund, which is already given in question rupees 2 lakh. Other than shareholders fund, capital employed is given to us, which is rupees 8 lakh. As I told you, capital employed has two approaches. One is asset approach, another one is liabilities approach. In this question, we will use liabilities approach because we are going to find out debt to equity ratio. Debt and equity, which are the parameters of this ratio, both are our liabilities. Hence, we will use liabilities approach. This red border will tell you what are the items which fall in capital employed. So these are shareholders funds and non-current liabilities. It means capital employed is equal to shareholders fund plus non-current liabilities. If I will remove shareholders fund from this box, what will be left with us? That is non-current liability, which is equal to debt. And the same thing I have shown in the first box. Hence, the debt is rupees 6 lakh. Now you know debt, you know equity, which is shareholders fund. You can easily find out debt to equity ratio, which is equal to 3:1. Now we are going to start with question number 42 of TS Kareval, in which we have to find out debt to equity ratio. The first item given to us is fixed asset with gross value. Gross means that accumulated depreciation we still has to subtract. And the same I have done. So you can see your total non-current assets are 7 lakh. Okay. Now the next item given to us is NCI, non-current investments, which is 14,000. So I've written here against non-current investment. The next item given to us is long-term loans and advances, which is 56,000. It's a part of non-current investment, has to be added in 14,000. The same I have done, and your total non-current investments will become 70,000. The next is current assets, which is 3,50,000. I have mentioned against current assets. Current liabilities, which are 2,80,000, I have mentioned against current liabilities. 10% long-term borrowings is a part of non-current liabilities, so 4,20,000 I have mentioned against non-current liabilities. Long-term provisions, which is also a part of non-current liability, so has to be added in 4,20,000, so your total non-current liability becomes 5,60,000. Now we will do total of assets because all three heads have been covered up. It will become 11,20,000 since it is a balance sheet. So your total liabilities will also become 11,20,000. Now debt is given to us, which is 5,60,000. We have to find out equity. In order to find out equity, if we will remove non-current liabilities and current liabilities from total liabilities, we will be able to know equity. And the same I have shown in second box. Hence, your equity will become 2,80,000. Now you know equity, you know debt, you can easily find out debt to equity ratio, which is equal to 2:1.